Well, hello and welcome to Business Incorporated live on Channels Television. It's another trading day right here in Lagos, Nigeria. Here's what's coming up in the next 55 minutes. As the Central Bank of Nigeria revises the framework for automated teller machine transaction fees, we'll discuss the details for more clarity. And Nigeria's all-share index hits a new high in February. Will this continue at the close of trade today? And global commodities are volatile as investors shift focus to a potential peace deal between Ukraine and Russia. It's great to have you join us. I'm Ladi Williams. Let's get a check on how your money is performing. Starting with the global commodities market, we see oil prices that took a dip today, fueled by hopes that a potential peace deal between Ukraine and Russia that could end sanctions disrupting supply chains. Meanwhile, concerns over inflation that soared as former U.S. President and the other presidents signaled plans for reciprocal tariffs there. But definitely it's all about what President Donald Trump is saying. Right now, investors listening in to see what next, for the markets. But we're seeing global oil markets impacted there, $74.09 a barrel, 1.45% down. We've been seeing big 1% rises this week. Well, this is the first big drop we're getting today. $70.25 a barrel. That's for WTI. Holding on by a thread there. Might go sub 70 if this continues in the trade tomorrow. And gold prices, they crept up today on the flip side as, traders kept an eye on on the president right now and his tariff proposals, which could spark a global trade war with key U.S. economic data on the horizon. Investors are staying on edge as spot gold, that was up about 0.2%, $2,908 per ounce, just shy of Tuesday's record high of $2,942. I know investors are wondering, when is the $3,000 psychological level? When is that going to be hit? We'll definitely be watching out for that. But all the metals we track, they're up today with palladium, the bigger mover, up 1.08%. All eyes still on President Donald Trump at this point. And to our first conversation now, the Central Bank of Nigeria has unveiled a new framework for automated teller machine transaction fees set to take effect from March 1st, 2025. The revised policy eliminates free interbank withdrawals and introduces charges of up to 600 naira for every 20,000 naira withdrawn. Well, we'll hear more now from Mr. John Simon Onoja, the Acting Director of Financial Policy and Regulation at the Central Bank of Nigeria. It's great to have you on the show.
Thank you very much.
So, definitely, customers are not so happy with this hike because it seems, 2025 is coming with, hike for this, hike for that. We're still battling the telecom operators, for their recent tariff hike. But now we're getting ATM withdrawal fees. That's going to rise at this point. And I'm wondering what's in it for the bank customer at this point, because some customers are saying, the banks charge us for everything, at this point.
Thank you very much. It's not charges for everything. Basically, the Central Bank of Nigeria has the responsibility of balancing the interest of all stakeholders in the issuance of its policies, and this is not an exception. And so, when we issued the policy recently, it is for the interest of both the customer and the operators. On the side of the operators, there need to be service provided, and they need to be also encouraged because of the cost of providing the service. And on the side of the customer, it is for the customer to have a better service delivery. And so if you look at the things that came out, the circular that came out, it is a balanced, provision of satisfying both the provider and the customer. Specifically, we are interested in ensuring that the customer has access to cash at the ATM, because our experiences have shown that most times you go to the machines and then you are told the cash is not available. So this circular is to ensure that there's availability of cash in all the machines, and then to also ensure that the provider is not also running out of profit. So it's a balanced circular that came out.
So I guess it's safe to say the reason why Nigerians couldn't get cash or still can't get cash at ATMs at this point is because it wasn't profitable for the banks.
Sorry, I'm finding it difficult to get the clarity.
Okay, so I'm saying, is it safe to say that the reason why Nigerians didn't have access or don't still have access to ATM machines like we used to, is it because it wasn't profitable for the banks?
I can't hear you, please.
Okay, we'll try that again. Can you hear me now? Can you hear me now? Okay, all right. We'll try and get the audio sorted there. Well, definitely because we know we've been all trying to get access to ATMs. It seems the POS operators seem to have most of the cash at this time, and we've heard complaints from customers saying they cannot get access to cash as they want. Even though we all want a cashless society, we're seeing the revised framework there. On us transactions, that's transactions that's in the banking with the bank you're using, that's with the ATM card. If you're using the ATM in their facility, then it's free. Then if it's a not on us transactions, that means you're using another bank ATM, with a different bank. So that's 100 naira per 20,000 naira withdrawal, and it goes as high as about 600 naira, depending on where you find that ATM machine. Let's try and get Mr. Onoja now. Mr. Onoja, can you hear me now? Okay, seems okay. Right, I can't seem to get Mr. Onoja now. We'll take a quick break now. Let's see how we can sort that out and get Mr. Onoja back. We'll be back in a moment. Just stay with us. Welcome back. Well, we'll still try and get back to those conversations. But we'll see economist and chief executive officer of financial derivatives company, Mr. Bismarck Rwani. He sees a 1.54% decline in the expected January inflation. Mr. Rwani was a guest on Business Morning earlier, and he believes that the stable foreign exchange rate as well as the reduction in the price of petrol have contributed to the expected decline. Take a listen.
As our projection, as against the current level of inflation, which is set 4.80. So it's a 1.54 decline using the old methodology for January. This is very important because this will be the highest, the greatest drop in headline inflation for many months, which means that one, consumer resistance is kicking in. Two, that money supply saturation is reducing. Three, that the exchange rate pass-through effect is having a positive pass-through effect in the sense that the exchange rate has appreciated at least somewhat in the last 3 to 4 months. But most importantly in this whole effect of disinflation that we are seeing is the fact that Dangote has brought down the price of diesel and brought down the price of petrol. This is very significant. Even though it reduces the producer price index more than it reduces the consumer price index. So it's important when you look at these things. But this is January, and January traditionally is a period when people have no money, people are paid school fees, people are paid their rent, and therefore they don't have money. So consumer resistance has a part to do it. But we cannot underestimate the impact of the reduction in the price of diesel, which just happened, and the reduction in the price of petrol, which happened a few weeks ago.
That's going to set the course for what the monetary policy is going to do next right here in Nigeria. That's talking about interest rates. We're going to have the first rate setting meeting in Nigeria. That's the first one for 2025. That's coming up next week, and definitely that's what's before the MPC at this point. The current inflation rate, what is going to be for January, and these are rebased numbers we're also expecting. Well, let's get some stories now coming out of Egypt. Now, we see for the 6th time since 2022, private sector workers in Egypt, they'll be getting a raise to the minimum wage, and that's coming in March, when employees in privately owned entities will receive a minimum wage of about 7,000 Egyptian pounds instead of the previous threshold of 6,000 Egyptian pounds introduced. That was May 2024. The minimum wage is determined through negotiations between company representatives and workers. The National Council for Wages oversees these discussions, which calculates the minimum income needed to cover the needs of workers and families each month, taking into consideration the inflation rate. So definitely a lot to unpack there, right there in Egypt. And we also see the Central Bank of Kenya. They're also talking about raising the 130 billion. They raised about 130 billion from their auction. That's the latest auction by the central bank there, and it's about 130.8 billion Kenyan shillings, and that's what was raised from domestic market following a treasury bonds auction held on February the 12th. The auction saw a strong investor appetite for the 2 infrastructure bonds and evidently received bids worth 193.9 billion Kenyan shillings from the prospectus. There was about 70 billion from the 2 bonds, but ended up accepting bids worth 130.8 billion Kenyan shillings, significantly surpassing its initial target, and that was due to high demand. So we're seeing the fixed income market there in Kenya not looking so bad, and we've also had, we're also going to be talking about what's happening with our fixed income markets. That's later on for the market segment. But let's try and get the conversation going again. I still have with me Mr. John Simon Onoja. Let's see if we can get a better reception. There's an acting director of financial policy and regulation, the CBN. I don't know if you can hear me now, Mr. Onoja.
Yeah, I can hear you now. Thank you.
Fantastic. So, yeah, we're talking about what's in it for the customer at this point, because it seems the average consumer is going through a lot, with hikes, with the tariff hikes and all of that. But at the end of the day, it's with ATM withdrawals. And some will say the ATMs, we're not even getting cash there at this point. And I was asking you, is it that the running the ATM machine wasn't profitable, for the banks? That's why we couldn't have access to cash.
One more time, thank you. I tried to say that, yes, it's a balanced circular. And as a regulator, the CBN is like the door that looks at both the inside and the outside. So we are not just on the side of the bank. We are also ensuring that the customers get the service that they deserve. Yeah, so on the side of the customer, what is the need for them, like in your words? Now, we are going to ensure now that the customer has cash anytime he goes to the ATM. And one other thing that you're going to see now, you must have seen an amount of 20,000 being mentioned several times within that short circular. And what that means is that the experiences that we have when we get to the ATM, and then you are told you cannot withdraw more than 5,000, especially when it is not on us, or 10,000 as the case may be, is going to stop. Now, you can withdraw up to 20,000 as you deserve or as you desire. You can have 20,000 at a go to withdraw. For example, in the past, if you want to withdraw 20,000, you have to do that like 2 or 3 times, as the case may be. So we are telling the banks that for a customer who has a desire to withdraw up to 20,000 at a go, he should have that all the time to withdraw, and that reduces the transaction cost we are talking about. So that's one of the benefits for the customer. And then to also let you know that at some off-site locations, premium locations where you neither have the bank, neither on us or not on us, you have ATMs that are going to be deployed, such that at any point in time you can walk into the machine and get your cash. And the cost of getting cash compared to what you might want to get from what is unconventionally going on is going to be low. For example, you are saying now, for a withdrawal that is not on us, you pay 100 naira. But for a withdrawal that is on us, it's free at any point in time and at any location, whether it is premium or conventional location.
All right, so definitely we've been talking a lot about trying to improve financial inclusion. Is the central bank worried that this might be a risk to financial inclusion, as most people here heavily rely on the ATMs for cash? Are you afraid these withdrawal fees might actually dissuade people from using these machines?
Rather, I think it's going to be the opposite of what you have observed, because the feedback we get is that because of non-cash, because of not availability of cash at the ATMs, people go to unconventional ways of getting cash, like I mentioned earlier. There are some people that are there that are illegally selling cash to customers or to those who need cash. And you agree with me that those costs are higher than what the 100 naira you will pay for 20,000. I'm sure if you go to the streets and you meet those illegal people and they sell cash of 20,000 to you, you're going to pay more than 100 naira. So it's rather bringing more people into the financial cycle. And again, to also tell Nigerians that they are going to have more ATMs deployed in remote locations where they hadn't been before, which is another way of furthering the financial inclusion drive. So it's the opposite of what you're saying, my interviewer. You're going to have more cash, you're going to have more machines, and you're going to be sure that cash is going to always be available at the machines, and you're going to withdraw more than what you could have withdrawn in the past.
So at this point, Nigerians can be sure that after or come March 1st, once we go to the bank ATMs, we can get cash and we can get as much as 20,000 naira.
Absolutely.
All right, so definitely we'll be looking forward to that. We'll also be tracking, to see how all of that plays out. But I'd like to get your outlook now. What are you seeing, for the rest of 2025? Is this going to be finally behind us? The whole issue of Nigerians having to go to or rely heavily on POS operators, to get cash. Is that going to be behind us? What are you seeing for 2025?
Yeah, let me also put it here that the CBN is also driving a cashless economy. Is in a situation where you don't need cash all the time to be able to transact your business. And so there are other channels of transactions that are also available through our payment systems. You can use the POS to make payment, the merchants are there. So that the cash you need is just in the event that you at least need a little cash. So we want to say that driving financial inclusion is also driving the cashless towards a cashless society. In the event that you don't need 1 million naira cash to transact a 1 million naira business, you could do a USSD transfer. You could go online to transact business. You can also go to a merchant and use your card to make payment. But in the event that you need minimum cash, that is why we say the ATM is there. But going forward, we want to believe that the banks have committed themselves to this drive, and you're going to be sure that the cash will be there. And right. On the monitoring note, you need to also know that the CBN has been monitoring the performance of banks through the ATM. We've been visiting the machines and ensuring that banks, and this is not probably to the public, but some banks have been sanctioned for not complying with the banking regulation on ensuring that cash is available always at the ATM. So while we roll out the policy with the commitment of the commercial banks and the financial institutions, we also have our monitoring team on the supervisory side to ensure that the circular is complied with.
Right, and I hope we also monitor the banks to make sure there are other channels work seamlessly, because most of the time you try to do a transaction on the bank app and it fails, most of the time, or the first time, or sometimes the transaction doesn't get to where you're sending it to, which makes people want to use cash. So are we also going to make sure that all the channels are working seamlessly?
You agree that the payment infrastructure has improved of late, very much improvement, especially in the past 1.5 years or thereabouts. And there's a continuous improvement on that. And so we ensure that sometimes technology could fail, but we're also monitoring the failure rate, which has drastically reduced from our payment system infrastructure and monitoring side. We've seen that the infrastructure has improved. And so I believe that Nigerians are going to have a better service through the use of other channels as well.
All right, we'll definitely hope that happens. But thank you so much. It was great having your perspective today on this matter. The Acting Director of Financial Policy and Regulation at the Central Bank of Nigeria, Mr. John Simon Onoja. Thank you so much.
You're welcome.
All right, so our next conversation now we see the global trade landscape is undergoing significant turbulence as tariff wars that's escalating, creating a ripple effect that extends far beyond the countries directly involved. For Nigeria, these tensions pose a critical challenge to supply chain, financing, the vital components of the nation's economic stability and growth. With supply chains already grappling with infrastructure gaps, currency volatility, and limited access to credits, the added pressure of tariff wars, that raises urgent questions about resilience and adaptability. Well, joining us to unpack this, we have Olusegun Shetan as a co-founder, Chief Growth Officer at Vendor Credit. Great to have you on the show.
Thank you for having me, Ladi.
So, a lot to unpack now. Everybody's just trying to listen out for what President Donald Trump is going to say, or do next. But, with global trade tensions, escalating due to the ongoing tariff wars, many are concerned, about the ripple effects on Nigeria's supply chain financing. How are you, seeing these tariff wars impacting Nigeria's supply chain, financing? And do you think our economy can weather this storm?
Thank you for that question, Ladi. Well, supply chain financing basically, finances the real sector. So it's not immune to any of the challenges, whether it's geopolitical or macroeconomic challenges that happen. With the coming of Trump 2.0, right, he's insisted that what he's going to do is to put America first in everything they do. Part of him implementing that is what has brought up the conversation around tariffs. He intends to drive investments in the US. Rather than attract people, he's basically bringing out the big stick to flog them to come and invest in the US. And tariffs is the tools that he's using. Interestingly, right, he's fighting against the top 3 traders, the top 3 countries that trade with the US. So we're talking about China, Mexico, and Canada. Combined trade is over $1 trillion. That's between those 3 countries. And our people say that when 2 elephants fight, it's the grass that suffers. Unfortunately, Nigeria happens to be one of the countries that are the grass in this particular case. A lot of his policies also, because they are protectionist in nature, have long-term impact on our economic and macroeconomic space. So you're talking about, for instance, the drill baby drill, which is basically upping US oil production from 13 million barrels a day, right, to higher numbers. And ultimately, we'd see the US moving from, an importer of, crude oil to becoming a net exporter of crude oil. Now, that has far-reaching impacts on countries like Nigeria that are oil producers. I think last year we did over $3.8 billion in trade with the US, right? And that was primarily oil-driven. So you can imagine what would happen if the US is taking away that from our fiscal budget plans. That's going to be serious for us. Also, there's the African Growth Opportunity Act that is maturing in September 2025 of this year. The initiative was supposed to enable African countries, right, to export to the US, in a seamless and easy fashion and cost-effective fashion as well. Under this regime, you cannot guarantee that by come September 2025, this is going to be renewed. There's also the outlook of the dollar becoming a stronger currency over the next, at least over the next 12 months. And that has big issues for countries like Nigeria that depend heavily on imports. So, there are a lot of challenges that it presents, right? I think even the World Trade Organization's DG, Dr. Ngozi Okonjo-Iweala, had said that, that the war between the US and China would translate to almost 6.4% loss in global GDP. You can imagine how whooping that would be. So I think, summary, there are a lot of challenges ahead,
right?
And we need to look deep and inward on how we're going to address these challenges that doesn't weigh us out.
All right, talking about looking, inward to address, these challenges, the challenges are undeniable, but there's always room, for, proactive measures, at this time. Break it down for me. What do you think can help minimize the impact, of these tariffs on a country like Nigeria?
Well, so I'll give a response on three tiers of response. The first tier, obviously, is the government. The government needs to look at what the impact of all these policies would be on Nigeria, where it is that we're exposed, and create strategies, right, that would translate to policy and ensure that the policy implementation is seamless, right? To ensure that, we are protected against the shocks that these policies or these tariffs would bring down to Nigeria. The government needs to ensure we have an enabling environment. They need to ensure that they spur and stimulate local production in a way that at the end of the day would ensure that, we're able to produce not just for the consumption of Nigeria, but also export our excess capacity to earn FX for the country. They need to identify areas where we have comparative advantage, products where we have comparative advantage, and invest heavily in those things and drive them. And we need to look at our SMEs as well. I mean, statistics are clear regarding what SMEs are doing. With over 98% of businesses are SMEs, and they account for 8 out of 10 people being employed. And this is a sector that has primarily been left by itself. So the government needs to enact policies, not just on paper, right? But they need to find effective channels, such as supply chains, right, to route investments and credit in that direction to ensure that it has a far wide-reaching impact on businesses. On the corporate side, that's the private sector side, they need to change, they need to look inward as well. Those that have a lot of import dependencies need to start looking for local substitutes to replace those items. They also need to invest heavily in training technical talent locally, because with the dollars going up, bringing expatriate talent is going to be a huge weight on their P&Ls. So they need to start looking on how to enhance skill locally, invest in talent, so that they can upskill and be able to meet the requirements that they have. They also need to look at supply chains from a different perspective. A lot of them kind of look at it like they're doing the vendors a favor, but the reality is that the vendors who are predominantly SMEs are partners to these businesses, and the outcomes of whether they're able to deliver on the jobs they've given to them or not, where it has far-reaching impact on those businesses. They also need to look at some of the terms of the contracts that are restrictive towards supply chain financing or the assignment of proceeds. Those things have to be reviewed, right, in a bid to spur financing in that space. And then lastly, the consumers. I remember when I was much younger and some Korean brands, auto brands, came to Nigeria, and we used to look down on them, but some people eventually bought them, and today those brands are now premium brands, and we're seeing that happening with the Chinese brands as well. So right. Our mantra as consumers has to be consuming made in Nigeria. Those are some of the things that we can do to resolve and mitigate against the impact of the tariffs of the U.S. against Nigeria's supply chain.
Exactly. I'm all for buy Nigeria at this point, and we don't need to import anyone to come do the work for us at this point. We need to save all the dollars we can. But looking ahead, it's important to envision a brighter future for Nigeria's supply chains. If we successfully implement these measures, what could the future of Nigeria's supply chain, what could that look like in your opinion?
Well, I mean, the sky is the limit in terms of what it is that we can achieve if the supply chain financing infrastructure in Nigeria is properly oiled. So think about it like this. Supply chains it's globally, right? It's been around for over 4.5 decades. It's a $2 trillion economy on its own, right? So businesses, governments, and even consumers, right, can leverage on it as a competitive advantage, right? It's not a flash in the pan solution anymore. So if these things are implemented, then we can see our efficiency go up. I think the stats for our logistics performance index, which measures how efficient our supply chains are, We ranked 88 out of 141 countries. Our ease of business as well. I think the last statistics was that we're doing about 131 out of 190 countries or so. So if we're able to channel the investments and the capital that is required in supply chains, it will have far-reaching impacts that drive efficiency of businesses in Nigeria, generate a lot of employment for people that are in Nigeria as well, boost our productivity as a nation, and then ultimately it creates a nation where there's collective wealth, right? That everyone is inclusive in sharing the commonwealth that Nigeria currently has.
Right.
So those are the things I see outlook for this. Yeah.
Right. I definitely, I can picture, what you're envisioning there, and it looks really, really good. But, thank you so much. We do hope for the best, in 2025 and beyond for the country. That was Olusoye Shetanze, co-founder, Chief Growth Officer at Vendor Credit. Thank you so much. Enjoy the rest of your day.
All right. Thank you, Ladi. Enjoy your day too.
All right, now let's head straight to the markets. Now let's get a check on what's playing out with the local bonds that hit a new all-time high. That was yesterday's trade, but we have Ini John Mekwa to bring us the details at this point. So, Ini,
yes,
it's a new one.
Yeah,
another high.
And I don't think we saw
NGX.
This coming, because I remember 2 days ago I had a conversation with analysts, and the perception was it's going to be a sluggish market for a couple of days.
First quarter, at least.
Yes, and then suddenly we're hitting a new high.
Thanks to Dangote Cement, that was yesterday, and a couple of the banks.
Yeah, we spoke to Dr. Ebo yesterday about that, and he did say that well, it seems like investors were just waiting for the right time to get on board Dangote Cement, and that time actually came. So that's why we're seeing a lot of.
And that was after about 2 or 3 weeks of profit taking on that stock. Then
yes.
boom.
So profit taking makes it enterable. All right, Ladi, thank you so much. Good afternoon, everyone. Welcome to the market segment. I'll just head straight. Yes, the NGX is excited at this time because we are 107,929.63, and that's up 0.10%. Now, just take South Africa. South Africa is in the red at intraday, but I love Nigeria. So let's talk about the fixed income. We haven't done that this week, and we know that last week we did have a Treasury bills auction. Today we have an OMO auction. MPC is next week. Earlier today, we had Mr. Rwani on our Business Morning Show, and he is projecting that our inflation will drop by about 1.54%. So how does all of this tie and drive investor sentiment at the fixed income market? We have joining us for that conversation, Demola Oshuntoke. He is the team lead ALM at Access Bank. Hi, Demola. Good afternoon.
Good afternoon, Ini. Thank you for having me.
Good to have you. Let's start from last week. We had a Treasury bond auction last week. How did that go? Oversubscribed as usual?
Yeah. As you can expect, it was a bit of the usual sentiment. What we saw, so 670 billion was offered across the standard maturities, which is the 91, the 182, as well as the 364-day paper. As you mentioned, we saw that well oversubscribed, well over 3 trillion, despite the DMO offering only 670 billion. We saw the DMO stick to their guns and sell just about 670 billion, so exactly what was on offered. What we saw them maintain the rates on the short and medium term tenors. So the 91-day fixed at stopped at 18%, for the 182 it was 18.5%, and for the long end we saw a decline to fix at 20.32%. So we can see that trend of rates declining, especially on the long end for Treasury bills.
And does that give us an idea of what to expect today during the OMO action?
Yeah, so I think, as you've mentioned, for the OMO auction today, about 600 billion is going to be offered, a similar size to what was offered the previous week. And if we go by the trend that we've seen with the market, we'd be expecting this to drop, towards the back end of last year. OMO rates were about 23.98%. At the last auction, they closed at 22.50 and 22.65%. So I'm expecting to see those rates come down, not by large margins, but just incrementally is the trend I'm expecting to see today.
Yeah, and do you think that perhaps if financial derivatives projection of a drop of 1.54% on the inflation number, if really that's confirmed by the MBS, perhaps we could see a cut by the MPC next week?
Yeah, so we're largely expecting that those inflation results will definitely set the tone for the direction that the MPC decision makers are going to take in terms of where they want to do. My perception is we're probably going to see, as you've mentioned, a slight decline, within our inflation numbers. And off the back of that, we do expect that we could possibly see our first, rate cut for some time. So that's what I'm expecting to see when that meeting takes place next week. But we patiently wait for the biggest for inflation.
Patiently indeed. Can we expect that to translate to a drop in yields and then, maybe a decline in demands of these bonds?
Yeah, so what we tend to see is we do see those rates set the tone for what happens within the fixed income markets. If we go by anything of what we've seen this year, we've been seeing rates decline, especially on the long end. As I mentioned at the start of the year, Treasury bill rates were, just under 23%. Now the last one closed at 20.32%. So my expectation is we'll continue to see these rates come down, not in small bits. So we expect to see them come down just considerably. So incrementally is what I'm expecting to see. So we'll continue to see that trend of rates declining within the market.
All right, declining rates, maybe not so good for investors, but better for the government and debt servicing. Yes. Thank you so much, Demola Oshitoki, a team lead, ALM, Axis Bank. All right, so Ladi, I think I'll just hand over to you now. Other markets in Africa were in the green. Egypt, Kenya from yesterday and all of that, but I think...
Yeah, and everyone's looking out for what's going to happen next with peace between Russia and Ukraine, but we'll definitely find out. But I guess we can see what's happening with...
okay, the other markets. Okay, let's... so we see there Egypt and Kenya are positive, but let's go to the Middle East and see it's mostly positive there. Looking at Dubai, Dubai is positive at 0.54%, 5,332.56. Abu Dhabi is also positive, and Saudi Arabia is the only negative at the Middle East for this afternoon. So it's down 0.17%. That's Tadawar or Qatar is slightly positive, so small that anything could push it off the edge, 0.01%. We move to the United States. Yes, President Trump is still there. Futures are higher as our traders are analyzing latest corporate earnings from that market, as the U.S., but the Dow Jones is slightly down for the futures. S&P is follows suit. Nasdaq is 0.11% in the green. I hear DeepSeek is back in the news, so hold your breath for what's going to happen at Nasdaq. I hear more adoptions of that. I think Ladi is one of those new adopters of that. But let's go to Asia now and see what's happening. The Nikkei is looking really positive this afternoon at 1.28%. Kospi is also in the green, 1.36%. The Hang Seng is, however, in the red. Shanghai in the red. And our dear India still in the red, but we see the loss this afternoon is not as much as it's been in the last few trading options. That's what we see for. This morning we had talked about China, and China is just coming out of a new year. They have new plans, and it seems like it's a strong competition between, of course, China and the United States. We'll see how that goes, apart from DeepSeek. They're also, Ladi.
And it's all about AI.
It's all about AI.
At this point.
Yeah, so if it's cheap and it's working good, I mean,
why not?
Why not? Exactly.
All right, let's keep deep seeking. Thank you so much, Adi, for giving us the details there. But let's get a check of what's playing out in Europe now. We see Europe's annual airport passenger traffic. There you see the pre-COVID-19 pandemic levels for the first time since 2024. Well, let's hear more now. We have Chiponda Chimbelu joining us right there from DW. Great to have you, Chip. So what were the trends right there? What is the data telling us?
Well, Ladi, European airports welcomed 5 billion passengers last year, and that is according to the trade association Airports Council International Europe. Now, that number was higher than the previous year, and it is 1.8% more passengers than in 2019. So air passenger travel numbers in Europe have recovered to pre-pandemic times. But the COVID-19 pandemic has changed the industry on the continent. The latest figures show that about half of Europe's airports are operating below pre-pandemic volumes. Now, the European aviation market has been transformed, and the recovery isn't even across the continent. The growth in the number of passengers was actually driven by a rise in international travel. European domestic air travel, on the other hand, remains below pre-pandemic levels, and there are even countries where it is declining. And this may also help explain why so many airports here, especially in smaller regions, are still operating below pre-pandemic levels.
All right, so what can we expect from the travel industry in Europe this year?
Well, there are different trends on the continent. More people are taking trains instead of flying when traveling domestically, and that is definitely the case in the EU's two biggest economies, Germany and France. A lot of the growth is actually coming from Southern and Eastern Europe. And in Eastern Europe, there are more and more people who want to fly. Southern Europe, on the other hand, has been getting more tourists, and that is the case for Italy and Spain, which are, of course, the EU's third and fourth biggest economies. But while international travel has helped buoy European air travel passenger figures to pre-pandemic levels, the region does face some headwinds. The conflicts in Ukraine and the Middle East have led to the closure of some airspace, and some airlines, including Germany's flag carrier Lufthansa, cut some Asian destinations last year, for instance. Now, having to avoid Russia's airspace has meant longer flight times, and that has made those routes less profitable, especially given that some competitors from Asia still fly over Russia. So geopolitical tensions and wars, Laddie, will continue to play a role in the industry's future.
Right, we'll see if that the peace talks actually yield results. About how the market is taking all of this.
Well, European shares have jumped to record highs today on the back of optimism over U.S.'s plans to begin talks with Russia to end the war in Ukraine. Now, the Stocks Europe 600 index is up around 0.67%, and it has notched another all-time high today. And that is off the back of food and beverage stocks, which are leading with gains after industry giant Nestle reported strong earnings. And Germany's blue chip index, the DAX, has had another intraday record high. Now it is up around 1.45%. And of course, it is the prospect of the end to the war in Ukraine that is helping. And on the other hand, it is hurting defense stocks because, of course, they would stand to lose should the war end. But there are some concerns here in Europe on top of that about the deal that President Trump is negotiating with Russia's President Putin. There is fear here in the EU that if they are not invited to the talks, Europe may be left to foot the bill of reconstructing Ukraine.
Right, so much investors have to look at, in most of these markets this year. But thank you so much, Che, for breaking it down for us. Thank you.
Thanks, Laddie.
All right, let's head to the livestock market now. How the price is looking? Let's get a check on beef now. We see that's a staple in Nigerian diets, and we've seen the price there up over about 130% from 3,500 naira per kilogram to 8,200. That was in June 2024. Let's talk more now to Ajewole. Tomiwa Ajewole is the analyst, financial derivatives company. So, Tomiwa, talk to me again. The prices, we still see most of them, elevated at this time. But what's driving up the beef prices?
Yeah, Ladi, good afternoon. Thank you for having me. The price of beef has actually skyrocketed, usually in the last 6 months, more than other commodities. Is up over 130% in the last 6 months, and it's simply just supply chain constraints that's causing this drop in price. There's lower beef supply in the Nigerian market right now, and the reason because of this is because just because there's insecurity in the northern region. A lot of where Nigeria produces a lot of its livestock is in the north, and right now there's a lot of insecurity in the region. So we're seeing cattle areas actually leave Nigeria and carry their cattle and farm to the neighboring countries like Cameroon, Chad, and Niger. They rather operate them because they have a better enabling environment. The insecurity causes loss of lives, and their cattle are also lost. There's a survey that showed that in some states, such as Bondo, before we used to have about 200 trailers of cows moving from the north to the south weekly, and and that has dropped now to daily, and now that's dropped to about 50 trailers of cows weekly. And not only in Bonny, if you look at Yobe, which is to have about 40 trailers of cow moving from north to south daily, that's gone to about 10. So we're seeing this lower supply of beef because a lot of the farmers are now moving. And again, there's still the issue of the ban on open grazing. There's still the conflict between the farmers and cattle rearers. So right now the business environment for cattle rearing is not fine, and a lot of farmers are just moving, and that's leading to low supply.
Right, and definitely there's an import-export market, for beef, but there's also this claim that imported beef is softer than local beef. Is there any truth to that claim?
Yeah, there's indeed the perception that imported meat is softer, and there's a little bit of truth to it. There are two reasons I would explain that. One is the fact that the local cows here are grass fed, so they move up and down, and that makes their muscles leaner and firmer. This is when we compare this to the imported beef, where the cows are grain fed, and when they are grain fed, it's like they have fats added to them, so that makes their own meat softer. So it's also the fact that when this imported beef, the cows there, when they are about to be slaughtered, they are stunned first, they are rendered unconscious. So this makes them not to have stress, and when there's no stress, there's no adrenaline. Adrenaline makes the meat and the muscles leaner and firmer. So in Nigeria here, the cows are put to a lot of stress, and they're just straight on slaughtered without being stunned. So there's a lot of stress that happens, and adrenaline flows, and that makes the meat leaner and firmer. So that's the reason why usually imported beef is usually softer, much softer than the local ones here.
All right. Well, I guess I'll put that to the test. But thank you so much, Tomiwa. It's always great having your perspective. Thank you.
Thank you for having me.
All right, let's get a check on what's playing out in the crypto market now with some of the headlines. We see MasterCard, they announced they tokenized about 30% of their 2024 transactions as a multinational payment services giant. They're reporting tokenized transactions about 30% more in 2024. Also recognizing that stablecoins and other cryptocurrencies, they have the ability to disrupt traditional financial services. Then the official Trump meme coin, that's saw a 10% increase after Upbit, a cryptocurrency exchange, announced it'll be adding the presidential meme coin to its platform. All right, let's talk to Olumide Adesina now, financial market analyst. Hello, Olumide.
Ladi, good afternoon.
Good afternoon, Olumide. So we're seeing the official Trump meme coin. It's rising, this time. Do you think investors that bought at the top, are they going to be out of the woods soon?
I share skeptic pessimism around the meme space, Ladi, primarily because of the liquidity leak coming to the crypto market. You recall that when the Trump token was listed on Binance, it went as high as $72. And right as we speak, it's really floating below the $20 mark. So it pretty tells you that investors have lost more than 2/3 of their value in the span of 6 weeks. However, the reintroduction of Trump token in other exchanges will definitely prop up some excitement. But recent price action shows that the blockchain which Trump token strives on has broken below the $200 support level. I'm talking of Solana. And primarily, that's because investors are taking risk off the table. Recall that Trump's trade tariff destruction has really affected the crypto market despite input in Bitcoin inflows by Strategy, which now has 500,000 Bitcoin holdings. But that hasn't disrupted the bearish run we're presently seeing in the crypto market.
All right. Well, definitely, it's quite a yo-yo move we're seeing there with Bitcoin there today, but it's still struggling. It seems there's a big struggle to get back above the $100,000 level. But from what you've seen so far, is it safe to say this is the start of a bear market right now in the crypto market?
I'm not as optimistic as I was in November, December, primarily because recent U.S. inflation data shows an uptick. And, when you factor in these trade tariffs, definitely economists are already forecasted that inflation might be elevated. That will definitely put Fed the interest rate cuts in the world's largest economy, United States, off the table. So that will definitely have an effect. So I'm quite cautious, but the Bitcoin strategy by the U.S. Senate is still in place. So that might give boost from. But as we speak, you could see that Bitcoin looks like it's going towards the 95,000 support line once again.
All right, so we're going into the weekend, and tomorrow's Valentine. Are you seeing red? That's with a theme, Valentine.
Yeah, we've seen red across major altcoins, but like the coins you mentioned earlier, Trump token. We're seeing PopCat, Pengu being listed on Coinbase. That definitely increased buying pressure. Dynamics about the crypto market is that on long term, it's still a bullish run. Whether you look at Bitcoin, XRP, Cardano, these coins have minted huge returns, but parabolically, 2025 has been a very tough year for the crypto market.
Yeah, even though it's still flirting around the previous high. So, is it safe to say we might see a major drop soon that could be the catalyst for the next bull run?
I won't put that out of table. Recall that a few weeks ago we saw Ethereum dropping as low as 2,100, Bitcoin touching the 91,000 mark, but bounced immediately. While some people argue that liquidation, leverage buyers have been washed away, we could still see that we are not seeing that liquidity excitement, particularly in the altcoin market. But I'm bullish on Bitcoin on the long time frame, probably because Goldman Sachs' latest filing shows that they've increased their exposure in Ethereum and Bitcoin. That probably tells you traditional finance is gradually coming to the space, and BlackRock's input with its spot ETFs tells you that Bitcoin definitely has a stay in traditional finance assets.
All right, we'll definitely keep watching. Still early days in 2025. Thank you so much, Olumide Adesina, financial market analyst. Thank you.
Yeah, thank you, Ali.
All right, so there you have it. That's how most of the markets we track. That's how it's looking today. We'll give you the TGIF trade. That's tomorrow, and John McCrory will be here to give you all of that. Thank you so much for watching. For me and the team right here at Channels HQ, it's bye for now.